So welcome to this, I can't remember if it's our third or our fourth series of ChaiTime. And, we've had some lively events, particularly during lockdown and beyond and after, on quite a wide range of topics. And but we haven't done SEIS as a topic. And given the changes that have just happened and how important it is for the early stage ecosystem, startup ecosystem, I thought it was worth having a ChaiTime around that. So that's the background for it. So yeah, I'm currently sitting in our office in Cambridge. It's dreary outside. We actually have a boot camp going on downstairs as well. I've told them not to come upstairs, but if there are people wandering in and out, let me know. But we've probably got about 100 people downstairs in a sort of tech boot camp scenario. So so fun and games there. So we'll kick off with some introductions, and I'm going to ask Fred first to introduce himself.
Hi everyone, and obviously thanks for having me on today, Sunil. My name's Fred. I'm one of the two founders and 4 partners of Haatch. We're an early stage fund backing primarily digital B2B SaaS companies at pre-seed and seed through both our SEIS and EIS funds. So very excited to talk about the changes to SEIS. And prior to that, used to run a retail business, which we exited to Morrison's, a supermarket. So retail technology and now investing.
So some of you might be thinking, why has Soneya invited another fund manager to come on his ChaiTime? And the answer is, those who run portfolios, it makes sense to de-risk your portfolio somewhat by having multiple fund managers. So I just decided to bring on another fund manager who I've been on a panel before. Talks very intelligently about what the investing hypothesis, and those wealth managers, IFAs on the call, may be thinking, okay, it's good to have fund managers who are sort of niche, who know what they're doing in their own specialist areas, and I think we do in biotech, and I think Fred has his own expertise as well. So hence I thought it'd be good to have a different perspective, but also to understand, look, investing is around managing risk and having a portfolio. So I thought it made sense to bring on another fund manager onto this call. So maybe Dom, you want to go next?
Oh, you're on mute, Dom.
Schoolboy error, sorry. So thanks, Sunil, and great to be here. Thanks for the invite. So I'm Dom. I'm the CEO and co-founder of a startup called Xploro. In brief, Xploro is a patient education platform that uses an artificially intelligent avatar, 3D augmented reality models, and a series of games to reduce anxiety for kids coming into hospital. O2h invested in us, I think, just over a year ago, wasn't it, Soneya? It was January 22. We've been through the painful process of a Delaware flip, so we're now headquartered in Cleveland, Ohio, as Xploro Inc., but I'm calling from sunny Preston in Lancashire today, so that's me.
Well, we'll dive into more about the flip and why and how that's worked out for you and how it affects the SEIS and EIS, etc. So that's been an interesting conversation there. So I've got Thelma on my right. So hey, Thelma.
Hi.
Maybe
so
I'm introduction to yourself and what you're doing at CardiaTec.
Yeah, definitely. Yeah. So hi, I'm Thelma. So I'm CEO and co-founder of CardiaTec. So at CardiaTec, we're Cambridge University spin-out. We spun out in 2021 and got investment from Soneya a year ago. And at CardiaTec, really, we're focusing on AI and multi-omics data to find the next generation of drug targets for cardiovascular disease, the world leading global cause of death. And
what's your background? What did you do before you founded this company?
Yeah. So my background is in VC. I'm in venture capital. So I worked at M Ventures before, which is Merck KGaA VC arm. And I was responsible at looking cardio investment opportunities there. And my academic background is in bioengineering. And then I did the MPhil in Bioscience Enterprise at Cambridge, which is a kind of MBA in biotech. And this is where I met my two other co-founders.
Great program, by the way. That's I think they've produced a number of interesting entrepreneurs in the space. So I think that's a good breeding ground for biotech entrepreneurs. Alice, you're on my bottom right there. It's a little bit dark in your room there. but we can see you fine. So Alice, a little bit of background and introduction to yourself, and maybe what you're doing at Nottingham, and the spin out that we're involved in together with Alevin, maybe the three-pronged tackle, your background.
Yeah, of course. So, you know, my personal background is I'm a developmental biologist, and I moved very rapidly into working for a university spin out, and then from then on into sort of innovation space and supporting small businesses with securing investment and becoming investor ready. My current role is with Nottingham Technology Ventures, and that's why I'm involved in one of the companies that o2h is invested in, Alevin Therapeutics. Alevin is focused on developing small molecule inhibitors of a certain molecular pathway, and we're exploring those treatments for fibrosis and oncology. So Alevin was founded in April 22, and o2h was the first investor into that opportunity.
That's great. I think we'll probably delve in a little bit, because a lot of opportunities in the SEIS space come out of universities, and that's because that's where you can be the first investor in. So I think it'll be interesting to see a little bit of a Nottingham perspective and a Cambridge perspective, maybe as to how that works, the tech transfer offices and the support that they can bring. So we'll delve into that in a few minutes time. But firstly, I wanted to come to Fred. I mean, there has been some legislative, I would say, big changes to SEIS investing. So maybe you can just summarize what those changes are in the market and what impact that's having you and on your SEIS fund.
Yeah, sure. I mean,
we'll come to how we relate that to risk in a second. So maybe we'll leave out the risk part.
No problem. I think there are immense changes, right? To be clear, I think this is fundamentally a huge change for the ecosystem. The first change is very much on the investor side. So investors used to be capped at £100,000 a year, and that's now increased to £200,000 a year. Remember, SEIS 50% tax relief, so it's £100,000 in tax relief that an investor can get back a year. Of course, married couples often invest together. So, you know, there's a significant improvement in limits there. But really what we're excited about as fund managers ultimately is around the portfolio company side. So companies used to be able to raise £150,000. It's been the same limit ever since the introduction of the SEIS scheme. Now it's £250,000. So the first money into a company under SEIS, £250,000 in the lifetime, up from $150,000. There's also two kind of sub changes on the company side. One is around a company can now be 3 years old. So it's been trading for 3 years instead of 2 years. And secondly, gross assets test is now increased to 350,000 instead of 200,000. So a couple of technical changes, but the one that I think is immense, which is, you know, very important for the ecosystem and makes a huge difference, is that £100,000 extra. So £150,000 to £250,000 for companies. And when I think about the change that that's made on the companies that we invest into, and the extra runway that gives them, or the extra proportion that it allows SEIS investors or an SEIS fund manager to make as part of that round, it's a significant uplift, right? So very exciting. So change on the investor side to the annual investor limits. But for me, the most exciting is actually on the portfolio company side, and it's that £250,000 instead of £150,000.
That's a great summary, Fred. Thank you. I mean, when we invest into biotech, obviously, it's much less risky when you can go in with a bigger ticket. And with a 150K ticket that you can invest into at university spin out or at startup stage, it was just too small. So it was a real struggle to, I would say, deploy SEIS money in a way that you can manage risk, because it's better to go with a larger, you know, pot of money, and not in all cases, but in many of the startups we do. So what we were having to do pre this is, you know, we could go to 100 or 150,000, and then we have to literally we may lead the investment from a technical point of view because we've done the due diligence, but then you're trying to bring in other funds to get up to, say, $1 million, where, you know, $1 million or £1 million, where you can actually have enough runway for that startup and to do enough meaningful science to meet your next value inflection points. And I think that's the struggle in I would say, in biotechnology. I think now with this 250K, at least you can properly cornerstone a sort of £1 million round and lead around properly with an SEIS investment and do the right technical due diligence. I think there's enough money in biotech that people want to invest, but people need a partner that can provide the industry expertise and the technical backdrop to an investment, really. So I think from a risk standpoint of view, I think the higher ticket allows less risky SEIS investments. That's my thought. I'll be interested to see what other people's experience with the SEIS scheme was, and whether they agree with me or not. So maybe we go to Alice first, because she's probably involved with a few out of Nottingham.
Yeah, so I mean, SEIS is a very important opportunity for the majority of our spin-out companies. So perhaps because I skipped that step, that at Nottingham we manage a portfolio of about 30 high growth IP focused companies, and so SEIS, EIS are really critical parts of getting those companies on their journey and working through those first rounds of investment. So the change in increasing the company allowance is really very significant, as Fred said, and I think it does just allow the companies that opportunity to build, to really get some of the initial work they need to do underway, and attract greater investment as well from the offset. So I guess the opportunities that we've looked at with O2H are sort of in the pharma space, therapeutic space. So they're very cash hungry. 150,000 does not go a very long way when we're looking at some of the types of technical development we need to do. So the opportunity to expand that and to be able to secure a bigger pre-seed round is very significant.
Thanks, Alice. So Dom, getting your funding round off the ground, and it's always been interesting to hear your experience and how SEIS helped you, and which other investors were you able to bring alongside into that kind of startup environment?
Yeah, so I think when we did your investment back in January 2022, we were right on the edge of that 2-year period, and we were pretty much limited by that 150K cap as well, because we had another SEIS investment alongside O2H. So, had it been now, those changes would have been incredibly useful to us, because we would have, obviously, we would have liked to have raised more, and we weren't able to do that. We were fully capped. So, but it was fundamentally important for us to get that investment at that time, because and as we can go on to talk about later, that then gave us the ability to go through the Delaware flip, build our traction in the US, and get established in the US as well. So it was phenomenally important for us, but we could have done with more at the time.
It's a good point to just delve into that a little bit. At least the initial stages of post your SEIS investment, you've sort of described a little bit about what you do. Maybe give the people listening a little bit more color, because I think your position is very interesting, and how you de-risked your investment post the initial seed funding that you got, including the Delaware flip.
Yeah, so I mean, in terms of de-risking it, I suppose what we and it'd be interesting to know what you saw the risk perspective as, Sunil. But from my point of view, I think we de-risked that investment by having really good governance. So we had a really strong board led by an independent chair with lots and lots and lots of experience in building transatlantic businesses, which is essentially what we're trying to do. Not only really good governance from board level, but also a cracking CFO who who really gets the numbers and has lots and lots of experience in, we're quite a strange company. We're not biotech, we're digital health, but we cross, gaming, emerging tech and healthcare, and our CFO has experience in all three at both CFO and CEO level in large enterprise businesses. So I think having that combination of, really good management team, really good board, certainly I felt de-risked the investment for investors, made us a safer investment than maybe some other startups.
Yeah, I mean, I think for us, Dom, with you, it was very much we were backing an entrepreneur. It was slightly outside of our sweet spot in terms of biotech therapeutics where we typically invested. But we really like the ethos of what you were trying to do with your education. You had a very nice sort of demo and a platform to build on, and we could see you had the relevant experience to build a company. So, I mean, often we will back the entrepreneurs very, very early on, because at that initial stage, you see so many business plans with great science and potential and you can do a lot of due diligence. But if you have a CEO that doesn't have the experience or can't raise money, then it means that you have to do a lot more, support hand-holding at that initial stage. So you do need a mix across the board. But I think with you, we saw that you had the credentials to really build a company. And so, each company is different. But I think if you ask the question, that's what we saw with you. And we were like the proposition. Maybe you just give us a little bit more flavor about that.
Yeah, sure. So, I guess I should probably say that what we do is driven by personal experience. So my background is I'm a designer by background. I've spent more years than I care to remember running digital and creative agencies, building products for other people, particularly in the emerging tech space. But back in 2011, my daughter was diagnosed with cancer when she was 13 years old. She's fitting well. She's 11 years cancer-free now, so she's doing great. But it was her experience of going through healthcare that led me to realise that that there was a real lack of information about what she was going to encounter on that journey. So no information about environments, no information about the people she was going to meet, no information about any of the technologies. So we started out building a solution to address that problem that was very much game-based, very much about delivering age-appropriate information to children in a mobile app. So that's essentially what the product does and what the origin story is. So yeah.
Great, thanks. So Thelma, similar question to you. Firstly, maybe you can give us a little bit more insight into what CardiaTec does, and then also how you got your initial seed funding off the ground, how SES helped you or didn't help you get things moving and take things forward.
Yeah, sure. So I think for us, this SES funding came 9 months after having incorporated our company. It was for us the perfect time to really scale up and getting the company off the ground. And this initial pre-seed round with SES and as well conventional investors enabled us to hire a skilled and complementary team. I think for us it was really key. Same for them. As at the early stage for us, it was building this talented team, and as well being surrounded by a good board and great advisors, which made us as well a de-risked company and put us in the right track for our start. And in terms of what we do at CardiaTec and where did we started, so it was the team. So for us, what we're doing is we're building a computational model using AI and multi-omics data, which is heterogeneous biological data sets, very large data. That's when we need a lot of computational power and a lot of experience to gather this data and make sense of it, to then find some usable result, which for us is drug targets. So I think for us, it was first hiring the right people, putting in place this whole model, setting up the whole foundation. And a couple of weeks ago, we obtained our first drug target predictions after our model. And so I think for us, we were in this right transition where we had the tools, we have built the model, we have built the team, and now we have obtained finally, a couple of years after that, our first results. So everything is going now from fantasy to real life achievement.
Thanks, Sam. I think with you, if I was to repeat, what made me and O2h invest, I think firstly, I think the we like to do collaborations early with pharma. We don't have the liquid markets that NASDAQ in US, etc. Although it's not a great place to be right now anyway. But we rely on those deals with pharma to give us maybe an early exit or an early return, or to corroborate the model. And I think when we speak to big pharma, they are hungry for novel drug targets. They have the resource, they have the bandwidth to do more, but having the right drug targets to work on is really important for them. And so we've seen that need from pharma, and that's really what enticed me to initially to take a proper review of it. I think also even before we had the SEIS in place, you had gathered very interesting investors around the table. So we were going in to invest with a significant amount of startup capital, let's say, but obviously we could take out the SEIS portion of that. So I think having other investors around the table that could help and support you as well, I think was very interesting. And I think we saw two founders that were working very well together and willing to listen. You come over to the office and we have these conversations, and I think that's very important at the early stage, that whatever we discuss, you action upon, you listen, and you try and take forward. So that's something I thought that could work very well. So having that understanding, I think, is quite good for the fund manager entrepreneurs as well. And I think that has worked quite well so far. And so the last question to you on that point is, what do you think you've done initially to de-risk the investment post the pre-seed funding?
So pre the investment, right? Before the investment.
Since you got the money, the SEIS, what do you think you've then done to, because I know you're going to go out for a larger round at some point in the near future, but what do you think you've done to de-risk the investment for future investors?
Yeah, definitely. I think for now, the first thing, obviously, as mentioned, the team. I think being surrounded by an amazing complementary skilled team, then focusing on generating value. So I think our focus was generating value, building the next value inflection point, validating our approach. So going by step-by-step validation stage of the model, the approach, and the potential commercial upsides of it.
Yeah, and that ultimately has led in generating some data, which could be quite valuable, and that's ultimately definitely. Yeah, one aspect of our business is as well, we're generating our own proprietary data. So we're generating the largest multi-omic data set coming from heart tissue, which is unique in terms of the biological insight you can get from it. And for us, it was definitely something that will de-risk the approach for the next investors coming in the next round, because it gives us this unique edge and this unique insight into the biology. That's great, Thelma. Thank you. So Fred, give us an example of a SEIS investment that you've made and what you think the founders have then done to de-risk that investment post you coming onto the table.
Yeah, look, it's a great question and really interesting actually to listen about other industries, because we live in B2B SaaS in tech, right? So I think what's very interesting about B2B SaaS investing is it's very metric driven. So there's very clear metrics that a SaaS company in our world needs to get to raise their seed round or ultimately their Series A round. And for Series A, there's a very clear-cut metric of £1 million of annualized recurring revenue, ARR. So our entire investment thesis when we invest is how do we support that entrepreneur and founding team get to £1 million of ARR? And that's either from pre-seed all the way through, or that may be raising a seed round during the course of that process. And I think what's exciting for me is that the industry has changed over the last year, especially in light of market conditions where revenue is again sexy, whereas before it was growth at all costs. And I think it's a much more sustainable way to build a business in digital with a focus on revenue. I think there's a few key areas. Everyone's spoken a lot about team, and for us, that's absolutely something that we look at. We look deeply into teams' working relationships. So do the founders know each other? Have they worked together before? What's that relationship like? And where's the gaps? We don't invest in single founder companies anymore. That's part of our investment thesis. That's where we've lost money, because we find in our industry that fundraising becomes a constant and we invest in technology businesses, right? And the CTO, co-founder CTO, is definitely not the right person to be raising money. And therefore, by default, you need two founders. So team is a huge focus. I think the big kind of part of our investment thesis, though, outside of team, is around the pain in the present. And what we mean by that is we invest in companies and founders that are solving a pain that we can all buy into that exists today and isn't something that may exist in 5 or 10 years' time. And that doesn't mean that the pain is solved today, but it means that there is a pain and there needs to be a product to solve it, merge the market, whatever it may be. And I guess finally, the dynamic of the round. So I think investing alongside other investors, and Soneya, you mentioned this right at the beginning, we love to invest alongside other investors, especially multi-stage funds, because you work with other people that have capacity to follow on at different stages, may have different metrics, may have different entry prices, or even different target returns that changes kind of the investment thesis or focus around the table. So we see founders de-risk through a great team, good governance, solving a pain in the present, executing quickly, focusing on revenue, and having a good makeup of investors and advisors around the table. But we maybe, have it a bit easier, I don't know, in the sense that there's very clear-cut metrics which companies need to hit. I don't live in the biopharma world. Maybe it's the same or maybe it's something different. But yeah, that's what I would say around de-risking.
It's some great points in there. I would say in the biotech world, you still have metrics that you need to hit. There's just every investment you make will have different metrics.
Yeah.
If you're investing in a CRO business or a contract research organization, it's revenues. If you're investing into a therapeutic business, it's data, and it's all having the right scientific data points that make the company or the drug or the product more interesting. So, but you have to look at each company individually, which makes it quite and feels easier when we're doing it. I'm not saying there's definitely challenge in it, but that's, I think, where we can add value as a fund manager as well. So Alice, in terms of Nottingham University, you must see some great, there's a huge body of work that's done within the university. And as I say, O2h has invested into the second spin out from Nottingham. We had Exonet earlier, and now we've got Alevin, and we find Nottingham a very easy group to work with and to spin out companies. And our conversation for the spin out probably lasted 10 minutes. So this is what we want to do. We kind of agreed it and we just got it done very quickly. And it's really a pleasure and nice to work with groups and teams like that. But, but on yourself, you see such a great body of science and research. How do you get these things started and spun out?
So, yeah, that 10-minute conversation was preceded by quite a substantial body of work that went on in the background. I think with Alevin, we felt very fortunate with the individuals that were engaged as the founding team. But
do you want to give some background of those individuals? The kind of body of work that had been done pre-spin out in a way.
Yeah, so the team that founded Alevin is a little bit different from our typical spin out team in that they are I'm trying to think how Tom had described it, one of the founders. I think he kept described himself as seasoned, meaning he has been in his career for some time. He perhaps has different personal motivations for creating a spin out company than maybe some of our younger academics might do. For him, this was not the next career move. This is something he wanted to see the fruition of a number of years of research from his industrial experience. He's ex-pharma, and also the experience in academia. So, I think it's something that's very. Sorry, I'm not sure what that feedback is, but yeah, I think for us, building a spin out is absolutely about the team. So we have a lot of work to do to identify external experts who can support our academic teams, commercial leaders, people with that expertise in raising investment and running businesses, because clearly, the company is about the science, but it needs that governance as well. And the critical bit for us in making the decision to spin a company out is that understanding of the market. So, you know, if it's a particularly disruptive technology, you know, we know, for example, if somebody's trying to sell into the NHS, that's, you know, something that's too disruptive can be a difficult sell at first. So it's about building the whole picture, taking a sort of a 360 view on an opportunity, on the team, and sometimes making difficult decisions around the team and the technology, and making sure that we have the right people and we're focused on you know, on the right element of the technology to take forward.
Thanks, Alice. That's some great points in there as well. So, I mean, I was just saying to Alevin, I've assumed that executive chair role, so I do know something about it. So there's a little bit of bias, but maybe I give some more. So, you know, Tom's background at AstraZeneca, and you know, it was long, and you know, that the experience that people that have worked in the larger pharma, coupled with his passion to really have impact now at the stage of his career that he has, I think is a great combination for a co-founder, because they're really working for the right reasons, and have the experience to be able to make good decisions and have the network also within industry, because in biotech you need to really dive deep in certain areas, and no one person can hold all the knowledge. So you need to have access to quite a good network of people where you can dive in, get the right advice, and then, you know, make the correct decisions. And I think that's you know, that's quite a value add really in sort of the team structure. And Alevin, I think, is going to be, you know, it's going to be, I think, a good company, a star moving forward. Hence, I'm very happy to lead that one. But and it's a great team, easy to work with, and with really solid science. So the next question really I have is around sort of the next round of funding. So now you've sort of got the initial investment, the SEIS piece. You know, we're in an industry where you need to raise the A round, or say the seed round. So you could call the SEIS a pre-seed round, then a significant seed and an A. And in this current environment, you know, has been challenging, and I can talk a little bit more about that, but it'd be interesting to hear, maybe we'll start with Dom, his perspective on raising the next round of funding, and how he's pulling that together and what he's doing. So,
sorry, I nearly forgot to unmute myself again before I started speaking. Yeah, so we actually raised another round at the end of 22, beginning of 2023, and I mentioned earlier that we did a Delaware flip last year, and the reason for doing that was because we had interest from US investors. And so the round that we raised just recently was entirely made up of US investors. Technically a seed round, I suppose. It was, well, in the US they'd probably call it pre-seed, because rounds tend to be a lot bigger, but it was $1 million round. We're already thinking about our Series A, which will be in Q1 or Q2 of 2024. So that round that we've just completed is really just enabling us to get to that point that Fred made of being at $1 million ARR by early part of 2024. So that's kind of where we are. I think it's interesting, the differences between the US investor culture and the UK investor culture. I think one of the reasons we focused on US investment is not just because that's where the majority of our market is. It's also because I think they tend to be, even in the current climate, they tend to be less risk averse. So they take more chances because they're investing more across a bigger spread. And so we found it easier actually to raise money in the US than we have done in the past in the UK.
Yes, my experience of the US, just to banter a bit, is that they quite like the UK investments right now, because in this market where there's less money around, what we've been quite good at in the UK is managing our burn rate. So we're quite frugal with our cash, and I think partly is our cost of execution is so much lower than in the US. Even today in this market, to get office space or lab space or a cost of people at any level is significantly higher than the UK. And the talent, I would say, at a certain level is equal, especially in the science fields and the kind of the body of researchers that is done before a spin out happens. So I think they like coming in. And the second thing, John, just to add, is that I think the valuations in the UK are lower. And so they're getting, in this market, they're getting better, more value for their money, I think.
Yeah, I think both those points are absolutely right. And in terms of the resource point, I mean, we're very definitely keeping all of our development and content resource in the UK. The cost of developers in the US is terrifying. So I mean, we have one US employee so far, but the new hires in the US will all be on the sales and marketing side.
We've just seen one of our portfolio companies, which we spun out of Dundee, and a very early stage company, first investor and etc. And they've just done a deal with a US listed company, a NASDAQ company, will give them around 65 million of milestone payments if successful, plus royalties on their first project. But that company, their whole R&D base is basically the company they've done a deal with in the UK now. So in effect, the research and development done for this listed company, which is Alevin Therapeutics, a significant proportion of that work is done in Scotland now. And so I think what you described is good. We're going to see more of that, where US, fundraising, market, CEO, etc. You have that top layer, and I think we will end up we're definitely in some companies already the R&D engine for a lot of these listed entities in the US and private companies as well, actually. So I think we can see more of that. But yeah, that was something that's happened quite recently in our portfolio. So Thelma, we've been chatting about your next round of funding and what that might look like. So what sort of things are you doing to gear yourself up for the Series A?
Yeah. So for us, the next round would be our seed round. So the previous one was a pre-seed round, so we raised 1.5 million, including o2h SEIS investment into this round. So it gave us like a good chunk of money to deliver our first concepts and validation stages. And we'll be looking to raise again in September, so by the end of this year, our seed round. And for us, like, it was really like building our platform, building our data set, proprietary data sets, getting our samples, getting our multiomics data, and then getting our first prediction of drug targets. So we received our prediction of drug targets a couple of weeks ago. So now we're in the process of refining them, and they will be ready to be put in wet lab validation, so like preclinical models for the next fundraise. So that's really the sequential steps for us. You're on mute, Soneya.
I think you're at an interesting time, an interesting stage of your development. I think you'll have quite a lot of traction in your A round, and I think there'll probably be a lot of international investors looking at you as well.
Exactly.
Sorry, go on.
Yeah, I think for the discussion of US, like getting investment, going to the US or not, I think it's a question we ask ourselves with my co-founders at the moment, at the seed or at the Series A level. I think for the seed, we might stick to European, so like local, and maybe go to the Series A in the US, because I think we're a bit scared about this. Like, as you mentioned, like flip, Delaware flip. I mean, this is something we can discuss later, but
I think the data shows that in the sort of the pre-seed seed round, that the significant amount of money, we say, that comes into companies is local. But as soon as you make it to those A and B rounds, that's when the international capital kicks in. They don't need, for them, it's significantly de-risked by then. The management's in place, the product market fit's ready, so they can literally just deploy capital without having to mentor, handhold, etc. But at that pre-seed seed stage, they feel uncomfortable, I think, coming in as an international investor without having a local partner to invest behind. So I think that probably would make sense given what the stats say. Fred, do you want to comment on that?
Yeah, I get it's also relative to fund size as well, right? In the sense that, US funds typically broadly tend to be significantly larger than European funds, and therefore check sizes are larger because that's the economics of a fund. And if I think about our portfolio, we've recently announced a Series A in one of our portfolio companies, AeroCloud. I mean, this company is 2.5 years old. We participated in their pre-seed through SEIS and EIS at the time. Back to the point earlier about smaller limits, reinvested in their seed via EIS, and they just raised £10 million, $11-12 million Series A round from a US investor, and the US investor wanted to do the whole chunk. And you just don't tend to see that. You do, but you just don't tend to see that the whole time in Europe and the UK. But yeah, 100% it's a reflection of later stage deals, bigger opportunity, more market scale, and also larger fund sizes. And therefore, they can make those bets, they can make those investments because they want outliers, right? And I think that's the only downside of this, the only downside of the American VC ecosystem, in my opinion, is that for them, it's binary outcomes. They want the big fund returner, or it's fine for it to fail. The kind of in between is in the failure bucket. Whereas I think, having a focus on revenue and building a business is really important as well, instead of just the binary big outcome or nothing. Yeah. Because, if you run $1 billion AUM tranche of a fund, a $10 million investment or $20 million makes zero difference. If it's a write-off, it's all about the one or two big paychecks for them.
I think. Sorry, John, go on.
So, sorry, Soneya, I was just going to.
Anyone jump in? And by the way, if anyone has any questions, put them on the app as well. But yeah,
I was just going to kind of add to that and say that I think if you're at Series A or above, then attracting US investment is possible regardless of where you're headquartered. But I think if you're below Series A, either seed or pre-seed, and looking to attract US investment, then you're going to have to do a flip and set up a US Inc. as the parent company. And if that's your route, then my advice would be to do that as early as possible, because the longer you take UK-based investment, the more complex the flip is going to be, and therefore the more expensive the flip is going to be.
That's a great point. That is a really good point. I mean, a lot of biotechs, because the exit market for biotechs in the US there's more opportunities because you've got NASDAQ there as well. So a lot of our companies, the good ones, have gone to the US, like Bicycle and others as well, Immunocore. And so they have made that flip maybe a little bit later, and it probably was more complicated. And we'll have to see what the government does in the UK now. It's another ChaiTime session, but we need to open up our own markets to make it easier to access capital and have exit opportunities with our own companies. I think it's a really difficult, long time horizon and too many moving parts and too many things to do to make it happen very quickly. Obviously, the government are definitely looking at that. But I would say on the seed and pre-seed rounds, given the current market environment, I am seeing US investors now more interested in coming in earlier into our portfolio companies, and they're contacting us directly to say, have you got anything in this space or that space? And they are considering earlier investments, just because I think they've realized two things. One is what we mentioned the point earlier around valuations and execution costs. But secondly, they realize they're missing out on some quite exciting opportunities, because by the time it gets to the A or B rounds, it may be harder for them to get in as well, because there are other larger funds in the UK that can invest at that stage. So they find it more competitive, and they may put, for them, it could be a very small check, but to put a little bit into a pre-seed or seed round and behind like a fund like ours or others, I think we're going to see more of that. And we're seeing definitely some direct contact from US investors on that front. We're getting towards the end of our 45 minutes. We've got a minute left, and look, it's been a great discussion. I don't want to keep it running longer than the prescribed time, unless there's some burning questions somewhere from someone within the audience. But I would like to close it at that point and say, really appreciate all your time. It's been a great discussion. I think the changes that government have made to SES have made it a much more positive environment to invest earlier. we found it quite difficult to deploy at that early stage. To the mindset of risk was just a little bit skewed, but I think now it's made it a much more interesting environment. I think it will be good for the UK economy. We'll get more biotech startups off the ground, and in a way that provides de-risking for individual investors and fund managers like us and Fred. So on that note, thank you very much, and we'll see you for the next one.
Thanks, everyone.
Thanks.
Thanks, Neil.
Bye.
Bye bye.